Hey everybody, Rob Maurer here, and today we are going to go through my Q4 2021 Tesla earnings preview and forecast episode. As a reminder, for the audio listeners, this is going to be a little bit number heavy, so probably worth checking out the YouTube video. And as another reminder for just even why we do these preview episodes, really just to understand the context of what Tesla's going to report. It's not necessarily to, figure out if Tesla's going to beat or miss earnings expectations or anything like that, although that is interesting to note too. It's really to understand the numbers that we're receiving from Tesla and how those are going to play out for the future. So we'll talk a little bit about that as well, but I always like to kind of start with that as the mindset as we head into these earnings preview episodes. So with that said, just a couple things on the market. Tesla today was down 1.25% to $918.40, while the NASDAQ was down 2.3%. So again, one of those tougher down more than 2% days at the NASDAQ. Anytime you have that, it's kind of a bottom 10 percentile day for the NASDAQ for the year. So rough markets continue. As we talked about earlier this week, Microsoft did report after hours. Last I looked, they were down about 3% after bouncing down to about down 6%. So it looked like the numbers were pretty good. I don't know if they've given any guidance yet. I'll have to spend a little bit more time looking into that, but hopefully just a little bit of an overreaction and that'll bounce back. But then obviously all eyes on the Fed tomorrow. That'll happen a couple hours before market close. And then we'll have Tesla's earnings report after hours, which I'll do the normal setup. We'll do a live stream for the call, and then probably a live stream for the shareholder letter as well. All right, so with that being said, let's go into the forecast here. As you can see, I've got the trailing 12 months over here, so we can just see the last 4 quarters. Then we've got the analyst consensus as compiled by Tesla. I did add a different column here for the analyst median. Normally we're looking at the average, but I did notice in this case that the median numbers were quite a bit different. So just for context, I wanted to include those as well. For the median, you're going to notice maybe that these don't necessarily all tie together. Like if you add up the sales for automotive, energy, and service, you're not going to come to the total sales. I think it's just a discrepancy with how differently analysts report different numbers. So don't get too hung up on that. All of these still should be, directionally correct. So, okay, let's get into the forecast then. Obviously, we can start off with deliveries. We kind of know that. Tesla always delivers a little bit more than they say in the just after the quarter end report. So I've added like 90 vehicles there, not a big deal, but that's going to be up 70% year over year, as we previously talked about. Getting into the revenue section then, I'll just go ahead and show all these right away. I'm pretty close to consensus. So here in this column, you'll be able to see how my numbers compare with the consensus. And you can see for automotive sales, including regulatory credit revenue, I'm pretty much right on, but because my regulatory credit revenue is 23% lower, I'm only expecting 275 million here, which continues to fall quarter over quarter. We could see that spike up, but I'm being a little bit conservative with that forecast. Because I'm a little bit lower than analyst consensus, that means my X credit automotive sales revenue is actually a little bit higher than consensus, which that's good. That's more sustainable, obviously, fundamentally stronger than just regulatory credit revenue. As for that regulatory credit revenue at 275 million, I do kind of wonder about this. We may see this jump up if other automakers kind of have to scramble due to them, their forecast being thrown off with everything that's happened in 2021. Maybe that caused them to go to mix their vehicles to higher trim, more expensive vehicles that are generally higher emitting. If you think about SUVs and things like that, that could cause them to have a greater regulatory credit need than previously or what they had anticipated having. So I wouldn't be shocked if that spiked up this quarter, but for now, since we have been seeing this downtrend, that's kind of what I've continued to forecast here. As for energy sales, so I'll scroll down a bit here. I am expecting Tesla to grow this pretty significantly this quarter. So we've seen the last couple of quarters, Tesla has continued to grow this. Last quarter, about 1.3 megawatt hour or 1.3 gigawatt hours. I'm up to about 1.6 gigawatt hours. So, whatever that quarter over quarter growth is, about 20% or so there, maybe 30%. So with that, that gets my energy sales to 925 million. That'd be up 23% year over year. And I am a little bit higher than analyst consensus on that line as well. For services and others, I have this up 45% year over year, kind of just looking at the trend that we've been seeing the last few quarters and projecting that to continue. Not a whole lot of super detailed forecasts on that. As the used market has continued to be strong, we could see stronger numbers through used car sales in the services and other line for Tesla. And then, of course, we did have quite a bit of limited edition merchandise, which probably not going to add a lot, but when we have, a couple $1,000 items like the Cyber Quad for kids, if Tesla actually did sell quite a few of those, it may start to add up a little bit for services and others. I am still a little bit below consensus on that line, but not a huge factor there. So overall, that puts my total sales forecast at just under 17.3 billion. The average analyst consensus right now is 17.2. The median 17.3 though. In fact, set at 17.1. So I'm right in that ballpark. Services and others offsetting, and then like I said, pretty close on automotive sales. So getting into profitability here, this is, as I always say, this is one of the first things that I'm going to look at when I open the report, because this will, like I said at the beginning, this is going to have the biggest influence on how Tesla's business looks for 2022. If we get really strong margins, that is a really strong sign of Tesla controlling their costs, which should be able to continue throughout the year. So this is, one of the most critical areas of the report. And for here, I am expecting better numbers than what the street expects. So automotive profit, even though our revenue numbers are similar, and I have less regulatory credits, which are pure profit, I do still have automotive profit being higher. So I'm about 100 million higher on automotive gross profit than where the street consensus is, though I am a little bit below the median. So again, just kind of a little bit of strange discrepancies there. Regulatory credit revenue, that's there. Energy profit, we've seen these margins be pretty small. So you can see here the energy margin I'm projecting is 3.8%. That's just continuing to show small recovery from really poor revenue or really poor gross margin performance at the tail end of last year and the beginning of this year. This was really driven by the solar roof though, and then Tesla changed the pricing and we saw a significant recovery, dipped a little bit back in then Q3. So I'm projecting that to kind of start to bounce back again here for Q4 with the better energy sales numbers. So for services and others, I have a $3 million profit in there, which might sound insignificant, and it is, but the important thing is that it's not a loss, what I'm forecasting. And this will be the first time I think ever if Tesla can hit that. You can see last year, Q4, they lost $143 million in services and others. So if Tesla can actually flip that to profitability, which they've kind of been trending at on average, even if you look back a few quarters beyond this, their average improvement in this quarter over quarter has been about 200 basis points or 2%. So I'm just kind of forecasting for that. If they do that, flip to positive, and that stops being a drain on the business, though obviously mixes in at a lower margin and still technically a bit of a drain on the business. Same with energy there. So putting all those together, you can see my total gross profit a little bit higher. The automotive gross margin percentage that I'm expecting is at 31%. Versus street consensus at 30.1, but again, that median is a little bit higher. And then automotive gross margin X credits. Again, this is key number that one of the first I look at, as you guys probably know by now. I have this up 90 basis points quarter over quarter. So, and 900 basis points year over year. That's just comparing to the 20.7% last year. So a good reminder of how much progress Tesla's made. But I think at this stage, people are more interested in the sequential progress than the year over year progress. So that estimate for me, 29.7% automotive gross margin X credit, that is 1.2% or 120 basis points, or I guess with rounding 130 basis points here, higher than the consensus expectation. That's really driving my total gross margin percent up. So I'm at 27.8% with everything included, regulatory credits, everything, versus the street at 26.9. So again, 90 basis points higher there. Before we get into the operating expenses, I do want to pause there and just kind of look at some of the factors here that are driving my forecast. So first off, on average selling price, this is the biggest wild card and unknown for me. And those of you that followed the Q3 earnings report with me know that I was too aggressive on my average selling price forecast in Q3, and that caused me to have a huge revenue miss. Here, I am expecting average selling prices to decline, which it doesn't really seem to necessarily be the consensus out there, but the reason that I'm thinking that is because Tesla delivered way more, I think almost 50% more, 40 to 50% more of almost both the Model 3 and the Model Y in China. And those are going to have lower average selling prices plus the standard range Model Y in China. I think that's probably going to be an even bigger mix of the Model Y vehicles this quarter than it was last quarter, because it was kind of just getting introduced in Q3. I think that's part of why I missed Q3 and was off on that average selling price. And if revenue comes in below consensus expectations, I think that's probably going to be a driver here again. So I am forecasting a pretty big influence from that. And then we'll also have fewer Plaid Model S's, as I think Tesla prioritized those in Q3. So even though we do get the Model X added in, I don't think that's going to offset the fewer Plaid Model S's because, again, Q3 there were, I think there were 8,000 Model S vehicles delivered, something in that ballpark. And I think this quarter we probably just had a couple thousand Model X, so I don't think it's going to entirely offset the declining average selling price on the Model S. And I think a lot of the orders for the Plaid Model or for the Model S are going to be those long ranges that were ordered a long time ago when the base price on that was $80,000, and now Tesla's raised that all the way up to I can't even remember. I think it's like $99,000. So I don't think those price increases are going to hit yet on the Model S, which is going to drag that down. As for the positives here, the price increases, those should continue to hit. We saw a lot of those in Q1 and Q2, and those orders should be heavily fulfilled in Q4 timeframe. So that is going to benefit, and I do have that reflected. But I only have the ASPs for the Model 3 and the Model Y out of Fremont increasing by a few $100s. I might be short on that. I hope that I'm short on that, but we're just going to kind of have to wait and see. So even though I do have average selling prices up in the United States, mixing in these other factors, or at least for the 3 and the Y, mixing in these other factors, I am showing the average selling price, excluding credits, down $600. If I'm off on that, that's going to create a lot of upside in all these numbers because that's going to drive revenue up and it's going to drive gross profit up. If I'm not forecasting enough of a drop there, opposite impact, kind of like what we saw last quarter, though last quarter, even with a missed average selling price, not a miss, but my forecast missed to the high side, even with that, Tesla delivered a gross margin beat to my expectation. So represented even better cost control than what I expected. I would say those are kind of like the two main factors that I'm wondering about with this report is that average selling price and then how Tesla's controlling costs along with those average selling prices and vehicle mix. So on the cost of goods sold side, which relates to obviously gross margin, here we've got working towards driving cost of goods sold down. We've got huge increases in volume efficiency. As we know, Tesla delivered 28% more vehicles this quarter than in Q3. That means they can amortize a lot more of their production costs. So even just the factory, the cost of the factory, and just more efficiency from their workforce. That all gets spread out over more vehicles, meaning the cost per vehicle declines pretty significantly. Definitely saw that in Q3 to a huge extent. I'm thinking we're going to see that again in Q4. And that's a big part of why I'm reflecting higher gross margins this quarter. As for the influencing factors driving cost of goods sold higher, again, we kind of have a wild card here with materials, sourcing costs. Sourcing, especially in Q4, can be tight, more expensive as a lot of people are doing a lot of business in Q4, a lot of holidays. Logistics just increase, and Tesla's going to be affected by that just like any other business would be. So it's important to keep that in mind. And then I just have a note here that Q4 historically does have higher cost of goods sold or lower gross margins. Hopefully not this time because of the offset of volume efficiency. But if you look back historically, Tesla has on many occasions posted lower gross margins in Q4 than in Q3. And that's a factor that has made me want to be a little bit more conservative in my margin forecasts. And if you remember back to Q3, I was kind of talking about that being a really clean quarter and wanting to see that be a clean quarter, kind of because of this factor. Q3 kind of gives us a pure shot, and then Q4 you've got kind of year-end costs, logistics costs. One thing that Tesla has done historically that they didn't do this quarter though is they've done a lot of expedited shipping. They may have done some of that, but certainly didn't seem to be as big of a focus. They've also done year-end discounts to an extent, or they've offered incentives. So that could be, free premium connectivity, free supercharging. Those things need to be reflected and often lower the gross margin. Tesla, because of demand being so crazy, hasn't done that. And then hopefully with this unwinding the wave theory, even though we didn't see that, hopefully the bigger focus on efficiency has helped reduce that normal Q4, increase in operating expenses, although not necessarily operating expenses, more so coming through in cost of goods sold. Anyway, bottom line on ASP and COGS, I have the automotive gross margin, X credits, increasing 90 basis points with all that stuff mixing out. But that's, again, the biggest area of uncertainty in my forecast, I think, is how that mixes out. And we can talk about these forecasts all day, and we can compare who's right, who's wrong. Ultimately, it's a guessing game. We don't know. And that's why we're talking about this stuff, so that when we do get the numbers, we kind of have a good idea and we can figure out where things go from here. All right, let's get into the operating expenses then. So I think we've got, unlike a lot of the uncertainty that's up here, I think we've got a pretty good handle on how these are going to come in. Let's hope, the famous last words, right? But so operating expenses, you're going to take your gross profit, add the operating expenses, and that's going to bring you down to net income. These are the fixed costs of running Tesla's business for the most part. So here, just to cut to the bottom line of operating expenses, I've got about 1.6 billion. And you can see I actually have that down quarter over quarter. And I then have being really, really consistent for the last, 4 quarters as a whole. A couple of factors that influence that may not be apparent on the surface are stock-based compensation, particularly Elon Musk's, and then the Bitcoin impairment, which we have had as a negative factor for the last 2 quarters. So when you see this, quarter over quarter decline, even if you just take out the Bitcoin impairment, which was $51 million in Q3, even just taking that out, excluding it, then you can see that, okay, the operating expenses actually are increasing here quarter over quarter. So let me look at my notes on this one. So let's see, working in the favor of Tesla, oops, just deleted my number there. Working in the favor of Tesla this quarter for operating expenses is CEO compensation. It's kind of working in favor, kind of not, depends on your compare, but here I have $158 million in CEO compensation. There's only about $300 million or so left on Elon's compensation plan. And if we look at the historicals here, you can see that that's only basically a quarter for what Tesla's kind of been recognizing. So we're getting really close to being down there. This quarter, I'm projecting 158 million. I'm expecting them to hit their next EBITDA milestone and recognize catch-up contributions of that of like 120 million, and then about 60% of the 55 million that's remaining to be recognized for achievements probable of being achieved. So anyway, too much detail there, but 158 million is where I'm at versus Q3 190 million. So you get some benefit to operating expenses from a lower CEO compensation number. And then as we continue after this, there's only going to be 150 million left. So if you spread that out over the next 4 quarters for 2022, on average, it's only going to be 30 million a quarter or something like that, 35 million or so. So this is dropping quick. Hopefully we'll get a new CEO compensation plan and those will go back up with time and more good stock performance. Definitely worth the cost, but it was outsized for the last 12 months, and that's going to start to be the opposite of outsized, I guess, as we head into 2022. So anyway, that's a factor in my SG&A. If we look at, I already mentioned the no Bitcoin impairment. If we look at stock-based compensation excluding CEO compensation, so this gets rolled into it, you can see I'm at 300 million, and that would actually be up 5% quarter over quarter. So showing a kind of a steady increase there. That's for all the other employees. And then SG&A excluding stock-based compensation. So just the remainder of this 1,003 minus this 458. For that, I've got 545 million versus 519 million in Q3. So again, up 5%. So even though it looks like operating expenses are declining, it's just a factor of the Bitcoin impairment and the CEO compensation, which both make sense. So with that, after subtracting operating expenses from operating income, or from after subtracting operating expenses from gross profit, that leaves me with operating income of 361 million, scratch that number, 3.163 billion. So almost 3.2 billion in operating income versus the street average at about 2.8 billion. So you can see that my forecast here is up a couple percentage points or 210 basis points from what the street is expecting. I'm at an 18.3% operating margin versus the street at 16.2 or median 16.5. That's huge. I mean, we've seen this over the last few quarters, 11%, 14.6%, 18.3% here is what I'm forecasting. That's tremendous. Most operating margins for other automakers are in that 5 to 10% range. Tesla is already, far surpassing that. and this continues to grow. And Zach Kirkhorn on the last call, though he did express that there's going to be some uncertainty and maybe volatility in that number, he does continue to expect that to grow as well. So that's where I'm at for this quarter. So getting into the bottom line stuff here, I'll just kind of unhide these first couple of boxes. So EBITDA, earnings before interest, taxes, depreciation, and amortization, I'm actually at $4.4 billion. I mean, if you looked at last year, they were at 1.9, and that was pretty solid for that period of time. Like, we were very excited about that number last year, already now up to 4.4 earnings before those other factors. So huge number here. Obviously that annualizes to more than, well, I guess we're close to 10 billion. I know that's like the easiest math ever. So annualizes to 17.6 billion if Tesla can continue that EBITDA rate. As for net income, I know what I was thinking. I was thinking 10 billion because if you look ahead to GAAP net income, I'm at $2.6 billion for GAAP net income, up from 270 million last year. So adding, $2.2 billion over the course of 1 year to their GAAP net income. Tremendous progress there on earnings. So what I was thinking there is that 2.6 billion, that's obviously annualizes to over $10 billion per year in annualized GAAP net income run rate. And again, that's including outsized CEO compensation at this point in time. So non-GAAP net income, that's just adding back stock-based compensation. I'm at about 3.1 billion there. Getting back to the comparison, I am showing about $300 million higher here. So about a 16% beat on GAAP net income from the street consensus. And then earnings per share, the number that everyone likes to look at, that is also overrated. On a non-GAAP basis, I'm at $2.68 versus the street at $2.46. And then on a GAAP basis, which is the number that's going to go into the price to earnings ratio you see on Google Finance or Yahoo Finance, I'm at $2.28 on a GAAP basis. Free cash flow, I haven't estimated. I haven't been doing that the last few quarters just because there's a lot of volatility there and kind of just depends what Tesla does with CapEx. But the street is expecting somewhere between 1.6 to 1.9 billion in free cash flow, which would grow Tesla's cash balance to potentially 18 billion or so in that range, even before factoring in Bitcoin. So very excited to see the strength in Tesla's business. We're going to see a lot of that show through this quarter, hopefully, and definitely excited for that. We'll come back to that deferred tax allowance, but let me just hit the notes for this income lines. So with this $2.28 forecast on a GAAP basis, if we look over the last 4 quarters, then I've got $5.13 in GAAP earnings, and that's going to be up from, when it replaces last year's Q4, which was only 24 cents. Right now we're at trailing 12 months, $3.09. And after this report, if my number's on, it's going to go to $5.13. So you can just see how fast this is increasing and how quickly that's going to be dropping Tesla's price to earnings multiple. Just what we've been talking about for, I guess, the last forever. But that's going to continue then in Q1. As you can see here, the last year Q1 number is also quite small. So, if you get another $2 in earnings for Q1, this next quarter, that's already going to be, almost $7 in earnings per share, which, it's growing quickly. So looking at that $5.13 number, just to give some context, I did this a little bit earlier when I was hoping the share price might close up at $9.50 for today. I think we're closer to $9.20 now, but at a share price of $9.50, the earnings that I have in here, that would be a price to earnings multiple of 175 times. And the forecasted Q4 earnings that I have here, if you just annualize that comes out to $9.12, which, we might see this drop for a couple of quarters as Tesla's ramping up, but those are, fundamentally short-term issues. This shows the strength of Tesla's business at its current scale, and it's only going to grow as that scale grows, even if there is a short period of time here where earnings or net income drops due to ramping up costs. Doesn't matter, it's short term. Tesla will get through it, it'll get ramped. Then they'll come back to this fundamental structure, plus the strength of the new business lines from Texas and Berlin. So I still think it's interesting to look at this annualized, even if we do have a short-term drop in that number. Don't necessarily expect that, but if we did. Anyway, point here being that at $9.12, that annualized number, that would put the price to earnings at 104 times. And, hopefully throughout 2022, we see this number increase again pretty significantly like we've been seeing. So bottom line there, multiple compression continues. And then the bonus there, so just as I said last quarter, Model S and X still not fully ramped. I think I have them at like a 19% gross margin for this quarter. Once they're fully ramped, they're going to double the revenue that they're contributing, and probably triple the profit that they're contributing. Just some super rough mental math there. But really they're, sort of neutral impact to the business right now. Once that's fully ramped up, that's going to be a strong positive. FSD, not fully recognized. I still don't expect that this quarter. I think Tesla will wait until we continue to see an even wider release, hopefully version 11. Maybe we see that in Q1. It'd be a great offset for some of these, ramping up costs that we're talking about for Berlin and Texas, which again, just a twinkle in the spreadsheet's eye. One thing here, so I do have the FactSet number. So FactSet's a little bit lower. They're at 239. But I did see an article that said that the whisper number, so whisper number, basically like what the street's talking about in terms of true expectations, which might vary from what we're seeing in these spreadsheets because some of these spreadsheets might not be updated, or averages and medians. Those are going to include numbers from people that have $250 price targets. So maybe those aren't necessarily good to use in terms of what the actual true expectations are. So the whisper number, that's more of, what people think the true expectations are. It's not an official number, but I did see an article that said that was $2.71. So I would actually be slightly below that whisper number. And I do think that's pretty reasonable because I think if you go through here, a lot of what I'm doing would probably match pretty closely to what the street's expecting. So yeah, it's just kind of a call out of, hey, if Tesla comes in and reports $2.68 and the stock goes down and you're kind of confused about, hey, they just beat earnings by, 10% or whatever. That's kind of what happens sometimes. So just something to be aware of. Again, I think if we go back to the average selling price and the cost of goods sold, that's the biggest area of uncertainty for me. That could drive these numbers pretty significantly in either direction. Hopefully the operating expenses come in as expected, but small changes up top can start to really drive pretty significant changes down here on the bottom. Another thing to keep in mind just in terms of reaction, and as I said at the beginning, mindset for what we're even talking about these numbers for, to understand what's going to happen going forward. The other big focus is guidance, right? And Tesla is pretty vague on their guidance in general. We have kind of that 50% growth rate, long-term target. Tesla doesn't guide for earnings or anything like that. And then of course we've got the product roadmap update, which we've talked a little bit about. Don't want to focus too much on that, but my hope would be that Tesla talks about how they're going to handle the introduction of the 4680 battery cells, because either way, you're going to have a lighter vehicle with the same specs, so it's going to be superior. You're going to have lower cost of goods sold once it's ramped up, or maybe Tesla could offer, use that extra space and weight savings and increased energy density to create a different tier of product line for the Model Y, maybe a Performance Plus or something like that, Plaid Model Y. I hope they kind of talk through the rollout plan for that. Obviously, we kind of expect them to talk about the Cybertruck and maybe finalize either a timeline expectation on that, or give us an update in terms of what the pricing might look like. I don't really expect that, but we know Elon is now talking about the quad motor. So we'll see on the Cybertruck. Semi, they'll probably talk about those deliveries to Pepsi and then just the ramp up throughout this year. Energy, I think there's a lot to talk about there. There's been some rumors about Megapack changes, so they may talk about that on that product roadmap update as well. And then I don't really expect them to talk about a cheaper Tesla. It just doesn't really make sense to me at this point in time. So I don't think they'll want to put too much emphasis on that. As for that guidance piece, I'm going to flip over to browser here because I do just want to point out one thing. So this is the outlook that we had. This is last year's Q4 update letter. And you can see in the volume section, this is really all we got for guidance. Okay, we're planning to grow as quickly as possible, multi-year time horizon, 50% average annual growth rate, stuff that we've all talked about. But they did say in some years we may grow faster, which we expect to be the case in 2021. So This first part is long-term guidance, not necessarily any guidance for the individual year, but Tesla did say, hey, it's going to be above 50% this year, or at least that's their expectation. They did end up removing that statement in the Q3 letter. So this is last quarter's earnings, and you can see that that has disappeared. I looked back at Q1 and Q2, and that statement had been included, but then Tesla did decide to drop it off in Q3. Obviously, by then for 2021, that was kind of a foregone conclusion. But what I do kind of wonder about is if Tesla was taking that opportunity to be even a little bit more vague and not create that expectation that when we come into the Q4 earnings report this time, that they're going to continue to say, okay, for 2022, yes, we expect this, or not. So this is one area I'm curious about when we get the report, is if Tesla does include, hey, 2022, we do expect to be one of those years, or if they just keep it vague, like they'd changed to in Q3, and say long-term 50%, and don't give us any clues on their expectations for 2022. So if they don't give us that, it might create a little bit of, not necessarily doubt, but I guess I don't really have a better way to put it, might create a little bit of doubt in terms of like what can be done this year, especially as we continue to wait for Berlin and Texas to, get started, which, by the way, I do expect an update on that. And hopefully the update for Austin is that they really have started production. And hopefully the Berlin update is that, hey, we're ready to go with pre-production and just waiting the final approval. Those would kind of be my two expectations on updates there. Okay. I think that is everything. I did see a couple of, I don't know if they were questions or just super chats, but I definitely appreciate those. Let me just take a quick look at that. I'll flip back here to Excel first. There we go. And I know that's a lot of numbers to go through, and we're going to have the actuals in a day, but again, this is like prerequisite work for me to understand the context, and then I might as well share that prerequisite work with you so that you also understand the context as we go into the report. And I think it's really good to think about some of these influencing factors like we talked about. All right, let me look through here. And I know for those of you that had asked a couple of questions on that last live stream, I know I said this at the end of yesterday's episode, but I do apologize that I missed some of those. I did go back and reply to any that I missed as a reply to the pinned comment on that episode from Friday. So if you had previously asked a super chat question and I missed it, it's there. Just in case you didn't hear that update yesterday. And I'll try to not do that right now, but we'll see. All right, just reading through here. Thank you, John, as usual. Really appreciate that. John says oil rising should keep demand solid. Yeah, I mean, we've talked a lot about it, right? The macro environment. There's a lot of weird stuff going on and volatility. So, oh, cool. Paul did catch that. Thanks for addressing my super chat in the previous stream. I'm glad you caught that note, Paul. Thank you, Jason. Pat here asking, why does Tesla use Ford Transits for mobile service? Well, they don't have, I've actually talked to some service people about this. Sometimes they'll use Teslas, sometimes they'll use a Model S. Rarely, I think maybe a Model X. But they use the Ford Transits just because in some occasions, like up here in Wisconsin, they don't necessarily have good charging coverage. Like if they have to head up north, that's one reason. And then just availability of vehicles, cost of vehicles. And obviously Tesla doesn't really have that form factor covered. So a myriad of reasons, and, individuals all have different factors for that, that are influencing those choices. But sometimes they do use Model S's. Team JG, thank you. Christopher, thank you. I didn't really intend to make this a Q&A thing. Happy to answer the questions, but yeah, mostly let's try to keep them earnings focused, if we do have any. Jem, thank you. Edward asking a really good question here. So why do you think earnings per share is overrated? Obviously earnings per share is important. I just think it's kind of like people look at quarterly reports and they judge the quality of earnings just based on, what the bottom line number is. So let me give you a really simple example of that. If Tesla reported no regulatory credit revenue, it would cut out $275 million from their earnings. And that would change the bottom line earnings per share number significantly. Vice versa, if they reported $500 million in regulatory credit revenue, it would, very easily lead to a beat, even if they miss in other areas. So the bottom line, the point of it about it being overrated is just that it doesn't really tell the full story, doesn't tell the quality of earnings. And that's why I like to go through this sort of piece by piece. I would rather have Tesla report $2.60 with no regulatory credit revenue, but beat my gross margin expectation than I would take that option, and rather than them reporting $2.80, but they miss my gross margin expectation and it's all driven by regulatory credit revenue. Regulatory credit revenue isn't going to scale to the degree that a strong gross margin number is going to be able to scale. That shows that Tesla's got extremely good cost structure on their entire business versus a beat based on regulatory credit revenue. That is, sorry, excuse me there. A beat based on regulatory credit revenue, that's going to, dissipate as soon as the next quarter. No one's going to forecast for that. And it just is ultimately not all that meaningful. Even though, yes, Tesla gets the cash and they can still use it. It's just the quality of earnings is different. And that's why I say it's not like great to judge, who did the best on forecasting earnings based on how close they were on earnings per share, or honestly, even the top line is probably better than looking at that, just because there are so many things in here that we can't know that are going to influence that. So yeah, it's just sort of like false precision. Really good question though. Thanks for asking that. David here asking, over 800% GAAP earnings growth, is that right? Can you talk about price to earnings growth ratio for a minute and explain it for people who are new to the concept? A couple of really good questions in there. So first off, yes, I believe that's right. So 862% net income growth. But that's because we had a really low basis last year. Tesla was kind of just flipping into profitability. Let me see if I think I've got some of the older quarters in here. Yeah. So you can see, Tesla was kind of just like plodding along here, not plodding along. They were still doing really good, but GAAP net income really hit that inflection point. And you kind of see, I believe this is probably like the Model Y launch sort of happening. And then certainly Shanghai ramping up too. So, yes, up 800%, but you also can't just forecast that into the future. Price to earnings growth ratio, I don't think really makes sense for a company like Tesla right now. I know people like to look at that, but that uses this growth rate. And then it applies it to the price to earnings. I would have to look at the formula to figure out exactly what Tesla's PEG is right now, but it's not something I use just because the earnings per share growth rate is not super sustainable, obviously. But as Tesla starts to become bigger and we move further away from that inflection point of not profitable to profitable, then I do think it starts to have a little bit more merit. So, excuse me. I do think that in a few quarters from now, it'll probably start to make a little bit more sense to look at once we start comping off some of these post, I guess, inflection point type of periods. The second part of that was, PG. Okay, I got that. Arik here asking, what are your expectations about FSD beta user counts? Well, my expectations is that we won't know them. I don't think Tesla will report them. Previously, I think I talked about this with Gally really recently. Previously, we had known the number was 11,000 from that NHTSA report. I think it's probably above 20,000 now, maybe 30,000, but that's just my best guess. Ultimately, not really all that important, I don't think, until Tesla decides to take that deferred revenue. Kai, thank you. The deferred revenue is significant. The I think they're sitting on like 1.2 billion or something that they expect to recognize. If they recognize that, that could drive, again, just like what I was talking about with earnings per share. Tesla could come in and recognize a huge portion of deferred revenue, and this could be then like $3.50. Sorry, I just had to clear my throat here. Tesla could recognize a bunch of deferred revenue that would drive GAAP net income up, earnings per share up. But if that's a one-time thing, then again, I'd rather have stronger automotive gross margin. That's going to drive better numbers in the future, which is really all that matters for a company like Tesla. Shoot, now I forgot what that question was. Oh, no question. Confusing myself here. What I did want to mention though, I know we kind of skipped over the deferred tax allowance. So same sort of boat there as like FSD deferred revenue, a little bit different, but there is a couple $2 billion sitting on Tesla's balance sheet that eventually they'll recognize deferred tax allowance. I'm not savvy enough to figure out when that's going to happen. I kind of just always put a question mark here because at some point we'll see it. And again, that'll go into GAAP earnings and, or I guess those would be GAAP earnings. It'll spike it up and the price to earnings ratio will drop significantly because of that. Analysts are going to factor that out, but it is something worth knowing about as it is going to have, at least an influence on perception as people kind of look at those numbers a little bit differently once those things are recognized. It shouldn't happen all in one quarter, but the majority of it should happen in one quarter. Maybe this quarter. I think Tesla would be wise to kind of save that until they've got more of those ramp up costs just to make things a little bit smoother, even when reflecting on a historical level in the future. So that's, I guess, my best guess, but who knows on that. Do you have a favorite macro hedge? Tesla. I know I've said this before, but honestly, that's my answer. And it comes back to this price to earnings compression, right? Like, as I've said, yes, this can definitely go lower, but it's just a matter of time, right? Like Tesla is going to continue growing. They're going to continue generating this operating leverage. There's a lot of things that are not even being reflected in their business yet that eventually will be. So it's just a matter of time before this really can't drop any lower. And that will overwhelm what's going on in the macro at some point. But you have to be a long-term investor. Like you can sit for long periods of time, for example, 2013 to 2018, where the market's trying to figure this stuff out. Not that that was as macro related, but sometimes it takes a long time. So you just gotta kind of be patient. But yeah, that's my best answer on that. I certainly am not like buying puts on oil or something like that. Not my style. Deferred tax, I answered that. Thanks for asking though. Scott, thank you. I think I'm getting behind here. What factors would you consider for demand concerns on vehicle sales? Certainly the macro. If we head into a period of continued inflation and the Fed tries to fight that back, fight back against that with raising rates. Obviously, it's not going to be a super great environment, but I don't know. I think, the demographic that's buying Teslas, they're still going to have disposable income. They're still going to want to drive a Tesla. Demand will be lower, but I don't think it's going to be lower to a degree that is going to do too much other than suppress Tesla's earnings power during that period of time. And this kind of goes back to like the whole debate that we've had in the past about like, oh, should Tesla advertise? Should they not advertise? People say, no, they shouldn't advertise because they're, production constrained. Another point of view would be that, yes, you should advertise and then just raise prices because ultimately you're going to get a stronger margin from making that combination of moves. And then people say, no, Tesla shouldn't do that because, it's not aligned with the mission statement. But Tesla's using that capital that they would gain to then build out more capacity, ramp up faster. So I think it's justified, not necessarily. There's more to that, but the point is that over the last 12 months, we've seen Tesla raise prices, and that is what they're doing right now. They're capturing stronger gross margins because of huge demand. So if you see demand decline a little bit, then Tesla's got flexibility. They can lower prices, but you're just not going to have that period of time where you've got as strong of gross margins potentially. So it's all related, and that's kind of what I'm talking about with like the China stuff is that as Tesla's grown deliveries there, Those are obviously happening at a lower average selling price because they have a standard range Model Y. North America doesn't. So it's kind of a perfect example of if there were stronger demand in China, Tesla wouldn't have to sell the standard range Model Y. They'd have stronger revenues. They'd have higher gross margins. So if that opposite situation occurs where demand falls, Tesla introduces a standard range Model Y in the US, things come down. And then your growth outlook is not as strong for that period of time. So the macro is definitely still going to affect Tesla. I don't remember even what the start of that question was, but Trend says, nice job, Rob. Really clear and concise this quarter. Thank you. I kind of thought so too. It's hit or miss with the live streams, right? Will stock price and Tesla earnings call be affected by the Fed announcement tomorrow? Yes, absolutely. Probably more so than Tesla earnings, honestly. I don't want to make any predictions on that piece of it, but I hope just the removal of uncertainty from having the Fed meeting over with and having some comments from them. A lot of times knowing is, even if it's bad, is better than not knowing in the market is kind of what I find. So hopefully getting through that will provide some stability, if nothing else. All right, sweet. I think I finally got to the bottom here. But yeah, thank you guys. Those were really good questions. And hopefully this, again, helps level set just the mindset and understanding of the numbers that we get when we get them tomorrow. And of course, we'll have these up when we do get the actual numbers, compare where things were different, and that'll help us, again, understand, if I miss on revenue, it's probably average selling price, probably a bigger mix of standard range Model Ys, which would be less bullish for the outlook on, 2022, I guess, in terms of margins. So this is going to have a pretty significant impact on how people look at Tesla over this next year. So it's important. It's a very important report. And a lot of the underlying factors here are going to, influence what smarter money is thinking about Tesla for next year. Again, it's not as simple as just going to the bottom and looking at that earnings per share number and working from there. Sorry, one last super chat saw come in here. This will be the last one I take. Any insight into Fremont and Austin Y production? Will Tesla switch Fremont Y to standard range lithium iron phosphate? I think they can do that, if I remember correctly, like starting in April. I think that's when some of those patents expire for lithium iron phosphate. So yes, it wouldn't surprise me. And again, hopefully that's something that we hear Tesla talk about in this product roadmap update is kind of like the strategy there. I don't know how open they'll be with that, but yeah, we'll see. All right, guys, that's going to wrap it up. I intended for this to be a shorter episode, but it was longer, but really good questions. Definitely don't mind having those conversations. If you haven't yet, hit that like button. I hate saying that, but I do appreciate the likes. It does help out. So at any rate, thanks for listening. As always, we'll be back tomorrow for the January 26th earnings bonanza, I guess. We'll have a couple episodes for that. And yeah, in the meantime, you can follow me on Twitter at Tesla Podcast. Otherwise, we'll see you then. Thank you.